Ladies and gentlemen, good day and welcome to the Indiqube Spaces Limited Q4 FY26 results conference call. As a reminder, all participant lines will be in the listen-only mode, and there'll be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal a operator by pressing star and then 0 on your touchtone phone. I now hand the conference over to Karan Khanna. Thank you, and over to you.
I would like to welcome you all to the 4Q and FY26 earnings conference call for Indiqube Spaces Limited. From the management, we have with us Mr. Rishi Das, CEO, Ms. Meghna Agarwal, COO, Mr. Pawan Jain, CFO, Mr. Vikas Agarwal, Head IR, and Mr. Vamsi Chatrathi, AVP Marketing. We would like to now begin the call with opening remarks from the management, post which we will have the forum open for an interactive question and answer session. Thank you, and over to you, Rishi and Meghna.
This is Rishi. Good afternoon, everyone, and thank you for joining us for the Indiqube Spaces Limited first earnings call since our listing. It is my pleasure to welcome our shareholders, analysts, investors, and all participants joining us today. Our earnings presentation has been uploaded on the stock exchanges and on our website, and we trust you had an opportunity to go through it. FY26 has been a landmark year for Indiqube. We delivered record performance across key financial metrics, supported by strong revenue growth, continued margin expansion, and a significant strengthening of profitability. We achieved our highest ever revenue of 1,469 crores, representing a growth of 37% year-on-year. EBITDA crossed the 300 crore milestone and growing at 60% year-on-year. Profit after tax improved sharply by 145% to 125 crores. Equally important to us is the fact that this growth has been accompanied by consistent margin improvement. EBITDA margin expanded from 18% in FY25 to 21% in this FY26. PAT margin improved from 5% to 9% over the same period. Our cash flow from operations also strengthened significantly, increasing 147% year-on-year to 304 crores. In a year marked by geopolitical volatility and broader uncertainty around the impact of AI on businesses and workspaces, our performance demonstrates the resilience of our business model, the competitive advantage of our workplace platform, and the strength of our execution. On the sustainability front, I am pleased to share that our 4 megawatt solar plant in Latur, Maharashtra is now operational. This, together with our operational 20 megawatt solar farm in Yadgir, Karnataka, and soon to be operational 2.7 megawatt solar farm in Virudhunagar, Tamil Nadu, gives us strong momentum towards our goal of transforming our portfolio to 100% green power. Beyond supporting our sustainability commitments, our continued focus focus on green power through open access and rooftop solar is expected to structurally reduce our operating costs, especially in times like what we are today, the energy costs over a period of time, and insulate us from the rising energy costs. Backed by expanding profitability, stronger cash generation, continued sustainability progress, and our CRISIL A+ stable rating, we remain confident in our ability to grow with scale, discipline, and profitability. With that, I will now hand over to my co-founder, Meghna Agarwal, who will take you through the operational highlights for the quarter. Thank you.
Thank you, Rishi. FY26 has been a year of continued operational discipline, focused execution, and steady expansion for Indiqube. As Rishi highlighted, our strong financial performance has been a result of consistent discipline in operations. During the year, we have added close to 1.6 million square feet in rent-paying area and launched 15 new centers. The growth has been achieved while maintaining a sharp focus on asset quality, center maturity, and client experience. Our steady-state occupancy improved from 87% to 88%, reflecting strong utilization and sustained demand across our mature centers. This also demonstrates the strength of our portfolio, the relevance of our offering, and ability to drive operating leverage as center stabilizes over time. Alongside portfolio expansion, the value-added services continues to be an important growth lever for us. Their contribution to overall revenue increased to 15% compared to 12% last year. This reinforces our belief that VAS is a key part of the workplace value chain. It allows us to deepen client relationship, extract greater value from each association, and provide a holistic workplace experience for employees. We've always believed that the workspace is no longer just physical infrastructure. It is increasingly about convenience, productivity, engagement, and ease of use. Our technology platform, MyCube, continues to play an important role in this journey. Over the last year, MyCube recorded 1.4 million transactions, reflecting growth adoption across our client base. Our new space management module and the vehicle pooling feature within our transport module have also seen strong traction. For Indiqube, growth is just not about adding more space. It is about building a platform that brings us stronger with scale, more valuable to clients over time, and more resilient across changing market environments. FY26 has been an important step forward in that journey. It reinforces our conviction in the long-term opportunity ahead and an ability to execute with discipline, innovation, and client centricity. With that, we look forward to addressing our questions on the Q&A session.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Shamit Ashar. Please go ahead.
While if we look at the area addition, that has increased by only 0.11 million square feet, which is approximately 100.
Shamit, sorry to interrupt you. Shamit, sorry to interrupt you. Your audio did not come through completely. Request you to kindly repeat your question.
Sorry, yeah. Am I audible now?
Yes, we can hear you.
Okay. Yeah. So my first question was that our occupancies have dipped to around 80% this quarter versus 85% in the previous one, whilst your area addition has only increased by approximately 0.11 million square feet. So is this dip because of a temporary reshuffling in your client portfolio? And
Hi, Shamit.
secondly, I'd like to know your capex. In the last call, you had guided that capex for the whole year would be, similar to the range of 1H, which was approximately 180 crores. So around 360 crore was your capex guidance in the previous call. However, the actual numbers came in at around 413 crores. And also, if we look at the area addition in the second half, it was slightly lower than the first half. So any possible reasons for this increase in capex?
Sure. So thank you, Shamit. So there are quite a couple of questions. I'll try to answer one by one. Okay. So on your occupancy dip. So firstly, occupancy of 81% is the end of month occupancy for the March 2026. But if you see, the more relevant metrics is the average occupancy during the year, which is about 84%. So therefore, the actual dip is only 1% and not 4%. And additionally, if you see, my EBITDA margins have increased from 18 to 21%. So if there had been a marginal meaningful occupancy decline of 4%, which is not there, such margin expansion would not have been possible. So that is your occupancy dip. So it is only 1% dip. Now on a quarter-to-quarter fluctuation, it's very important for, in fact, every one of us to understand. There are two key metrics we track on an annual basis and not on a quarterly basis. Those are the area, which is, or the area sees addition, or the second is the financial performance, which is about revenue and EBITDA. From an expansion perspective, we plan to add approximately 1.5 to 2 million square feet every year, which means 33,000 seats to 44,000 seats every year. And we aim to maintain occupancy level of around 80 to 85% at the corporate portfolio and about 85 to 90% at the mature center level. All this would translate into an overall top line growth of approximately 25 to 30% and EBITDA of about 18 to 21%. So quarter-wise fluctuation in a rent yielding area or a area addition should not be viewed in isolation and is extremely natural and can arise due to factors such as timing of the new area addition, the ramp-up phase of the newly operational buildings. Overall, the important matrix is that we have outperformed the guidance of revenue of by 7%. We said about 30%, our revenue growth has been 37%, keeping our EBITDA in 18 to 21% and the PAT in the range of 8 to 10% as per the guidance. So quarterly fluctuation in this business would happen. Okay. So on an overall, what you have to see is my occupancy is going below than 80% in the overall, or the mature center going below than 85%, is my EBITDA going below than 18%, or my PAT going below 8%. But quarterly fluctuation in this business is very, very natural. Your other question about the capex. You rightly said our overall capex for the year starts about 414 crore. The capex deployment actually is the total of capex on interiors, the design build, the solar investments, and the vendor payment cycles. So I'll give you the bifurcation of that. So 256 to 248 crores is about the capex interiors. Your design and build, we spent almost about 50 crores. Our solar investment was about 73 crore, which is for the captive use and is generating close to 22 to 23 crore of savings per year. And our vendor outstanding and advances put together is about close to 30 crore. So that would make an addition of 414 crores. So the delta, what you are seeing is nothing, it's the solar investment, which is generating the saving of 20 to 23 crore. I hope I'm able to answer all the questions.
That was pretty helpful. And any guidance on the seat addition revenue growth for next year, 27, and the capex as well?
Yeah. So guidance again, we have always added 1.5 to 2 million in the rent paying area, which is, as I said, is a 44,000, and we continue to do so. And that would translate to the same occupancy EBITDA. So the top line growth you can again see in the range of 25 to 30%. And my capex would also be in the range of the same factors as I said, if I'm adding, so my per square feet of the capex is about 1650. So depending on the area addition, multiply by 1650, the similar vendor payment cycle would work, and there would be a capex on the solar. So in next year we plan to give you some kind of a bifurcation of the solar, so that it is much clear on how much capex or what kind of investment we are doing on the solar and sustainability initiative.
Right. Thank you. This was helpful.
Thank you. We have a next question from the line of Adidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, good afternoon, everyone. Congratulations to the management for an excellent year. The first question is really on our lease liability events upcoming now for the next year. If you could give us some directional guidance on will it trend in line with the growth in revenue, or it may be higher or lower than that? If anything, you could guide us on that, on the lease payments for the coming year. So.
Yeah, good afternoon, Adidev. I think you are asking more in terms of the lease liability, right?
Yeah. The 650 odd crores of payment, right, which you have incurred in 26. So basically, will this any growth in this, will it be in line with the revenue growth or lower than that or higher, whatever, depending on this.
The voice is not at all clear.
The voice is actually ruffled, Adi, so it's not very clear.
Not able to hear.
Voice, I don't know if we could also see the.
Yeah, is it better now? Is it better now?
Yeah. Yes.
Okay.
Mr. Adidev, probably you could go off the speakerphone. That would help.
Yeah, no, fine. So the question was mainly on our lease payment for the coming year. My question was that will it be in line with the revenue growth or higher or lower than that? That is, if you could give us some directional sense on that. Yeah, that was the question.
It is in line with the revenue growth, As I said, it would be definitely, Adidev, in line with the revenue growth. The top line would be in line with 25 to 30%, as said. So EBITDA would be in the range of 18 to 21%. So yes, the cost would be in line with the growth itself.
Okay. Yeah. Second question is on our solar investment. So you said there's a saving of 22 to 23 crores, right? So is it fully reflected in the FY26 financials? That is the first part. And going ahead with whatever investments we are planning in solar incrementally, any guidance on where this number may land up for a couple of years from now in absolute terms of the utility saving? Yeah, that is the second question.
Yeah. So basically, the depreciation on solar will be in this year, because a large part of deployment happened towards the later part of last year. Like October onward, we started getting systems live. So it happened till March. So this year is where you will see depreciation coming in, and as you will be aware, we will be eligible for accelerated depreciation, and that will help us improve our PAT, because we have 40% accepted depreciation on solar. So that should be a healthy thing for us. Now, what we are intending for the coming year is about 30 megawatt of solar addition, 35 megawatt of solar addition next year. Because what is happening now, our internal area that we are adding, as we are adding more area, we are ensuring that area is green from day one. So that is one requirement. Also, we are now finding a lot of GCCs and all coming to us asking they want to set up micro and mini data centers within our facilities. We have now two such clients which are, I must term them as power guzzlers. They are consuming a lot of power. And now, since we are one of the very few guys who have 100% clean power in a lot of our buildings, so as a result of that, we have a double advantage. One, we are able to provide them high quality infrastructure and also provide them green power. So keeping in line with their requirements also is where we will see addition of power happening in our Karnataka, Tamil Nadu and Maharashtra plants. So we'll keep adding power as our customers are going to have more consumption. Plus, as whatever addition of spaces are happening, that will happen. So about 35 megawatt is what we see will be the addition. And predominantly, we are focused on three states, as I mentioned to you, Karnataka, Tamil Nadu and Maharashtra for the coming year.
Okay. And my final question is on the demand side. So obviously you talked about the AI-led disruption and other global factors. But what are you seeing on the terms of the demand trend? Is there more demand for flex, or how are corporates looking at based on your conversations, I guess, with companies? To just understand the impact, either positive, negative, whatever you think we are likely to see for the next 12 months probably. Yeah.
Yeah. So, if you look at the calendar year 25, the total office absorption, gross absorption was about 82.5 million square feet. And in the Q1 calendar year 26, which is Jan, Feb, March, the absorption has been totally 20.7 million square feet. And that is quite substantial. And the way last year has gone, I think we see a repeat of that happening in this year also. And within this, Bangalore leads the pack with about 29 to 30% market share. And the absorption that we are seeing for this year looks like 5% higher than last year absorption. And plus, whatever space I talked about 23% of this space was absorbed by flex operators. And the GCC absorption has been almost 44%. So we are seeing a very healthy uptake of office spaces. And so far, we are not seeing any impact of the war. In fact, if you ask me, because of the depreciating rupee, we are seeing that because it's a export-led industry, we are seeing that a lot more work will come to India, because now $1 is more attractive to bring to India. So we are anticipating good growth over here. One more factor people are asking, of course, about the AI impact. So far, we have not seen the impact. And when I talk about GCCs, one thing we have to appreciate the fact is that look at, say, for example, US banks. US has 6,000 banks. And as of date, I don't think even 60 banks have come into India. So you can imagine the long tail that we are going to talk about, which is going to come over the next 4-5 years. Plus, within the GCC segment, we are seeing a lot of diversity. We are not just seeing the GCCs as a North America phenomenon. We are seeing as India is doing FTAs and the current geopolitics, we are finding a lot of European, East Asian, global capability centers also coming to India in a very, very big way. And whatever was more looking like a BFSI retail kind of a mix, we are now seeing a lot more uniform mix where logistics, healthcare, typically, or manufacturing, those kind of global shipping, mining, Those kind of global capability centers are also coming to India. Now, one peculiar trend about global capability centers is that they don't tend to hire like in 4-digit numbers. Most of them will be having high quality people in 3-digit numbers, but the volume of GCCs that is coming in is very, very high over there. So as a result of that, we see that the space absorption will be GCC-led over the next maybe couple of years. And high quality mix is what we are seeing is very likely to happen. Yeah.
Okay. Yeah. Okay. Thank you for the detailed answer. Yeah, that answers my questions. Yeah. Wish you all the best. Thank you.
Thank you.
Thank you. Participants who wish to ask a question may press star and one on your touchtone telephone. We have the next question from the line of Saurabh Gilja from JM Financial. Please go ahead.
Yeah. Hi, good afternoon, and thanks for the opportunity. Just wanted to get your sense on the trajectory for occupied area. It has remained same for last 3 quarters, although we have added some area in the operational bucket. But just if you can share some sense how this operational area of 6.3 million square feet should pan out over the next 2 quarters.
So the question is, how is this, my area under management, which is about 9.66, would get converted into rent-paying area? Is that the question?
Yes.
Yeah. So the area under management, which is about 9.66, so it is under, different stages, and it should get into the operational in about next 18 to 24 months.
So, my question was more on the occupied area, although we have seen some area getting, operationalized, like for example, from Q1 to Q4, the total rentable area was increased from 6.5 to 7.8, right? Although that area is getting converted into rentable, but that rentable area getting converted to occupied is what my question was. How the trajectory for occupied area should move going ahead.
So occupied area would actually, the way what I said earlier also, that we would be adding 1.5 to 2 million square feet every year. And our occupancy would be in the range of 80 to 85%. So on that basis, my occupied area would get translated. So we have to see it everything annually. Like today, we are sitting at 7.84 rent paying area, and the rent yielding area is 6.23, which is almost like about 81%, right? So that is what I said. So quarterly, it's not the right matrix to look at. Annually, in the similar way, the moment we add 1.5 to 2 million, my occupancy on a portfolio level will be between 80 to 85%, and the mature centers would be in the range of 85 to 90%. So as and when my rent paying area would get added, you take the occupancy percentage, accordingly my rent yielding area would be added. Did you get it?
Yeah, I got it. Thanks for the detailed answer. Just on the VAS, although we have mentioned that it's a ongoing thing, but on the one-time VAS contribution, which was close to 40 crore this quarter, so any sense that you can give, first of all, what is contributing to this increase, and what the trajectory will be going at?
So yes, you're right. You're absolutely right. That VAS, which is reoccurring and one time. So all these services are so bifurcation is like IT products. If any company wants to, to take the IT products from us, or the design and build, if they've taken some kind of a different kind of workstation or the chairs and all, and they would like to do pay upfront, So those are we call it like one time, and reoccurring is something which is amortized over time of 3 years or 5 years. So one-time VAS is difficult to predict, but as you said, we are currently about 15%. Last year we were about 12%, so we increased by 3%. We expect the contribution of VAS revenue total. Now we cannot be able to tell predictive like what is the one-time or reoccurring, but total we expect the contribution of VAS revenue increasing by 2 to 4% in the coming year. So from 15%, we see going up till about 17 to 18%.
Okay, sure. Got it. Thank you.
Yeah. Thank you.
Thank you. We have the next question from the line of Yashish Gilanchi from Bob Capital Markets. Please go ahead.
Good afternoon, team. Thank you for taking my question. I see that IT/ITES tenants now account for approximately 49% of your rents, down from approximately 51% as of FY 25. And Indian enterprises account for approximately 58% of your rents, down from 60% last quarter. So is it right to assume that Indian IT tenants are reducing their footprint? If so, how do you expect your tenant mix to change over the coming year?
So I think this will broadly remain the same, typically, or honestly speaking, in terms of vertical split. As I mentioned to you, that the GCCs are throwing up a lot more diversity in terms of manufacturing, logistics, healthcare, and all of that. So you might see small movement, but this will be more gradual. I am not seeing any very abrupt shift happening into this mix. IT/ITES will continue to be the larger one, maybe a percentage point here, there kind of a number. Yeah. I don't know if I have answered your question. Yeah. Anything you want me to? Sorry.
No, sure. That is clear. With tenant lock-ins at approximately 38 months and lock-ins with your landlords of approximately 38 months, I want to understand that I understand that your assets and liabilities are well managed, but please help me understand why your landlords are willing to agree to have the significantly longer 15-year lock-ins. Any light you can shed on this dynamic?
So, see, what happens from a landlord point of view, because they mostly give us a bare shell space. So for them, the cost of us re-exiting is minimal. But since we are putting our fit-outs, we are putting so much of skin in the game. And as you can imagine, if you have to get out, you will typically not get great value of your interiors if you have to pull them out. So as a result of that, basically we look at request or expect them to give longer lock. It's exactly like the way you see hotels, for example. Hotels will never sign up spaces where they get at least a 15-20-year lease, like very much. Plus even retail for that matter is mostly 9 years. So I think very similar nature, and that's where the landlords are agreeing to it, and that is a typical industry norm as well. We have been able to do that, and we have not seen any challenge now, and we don't see anything happening henceforth. Yeah.
Understood. And lastly, as VAS contributions make up approximately 15% of total revenues, do you expect to be able to drive this higher? And are further improvements to margins going to be solely driven by improvements in occupancy?
Yeah. So, as Meghna had mentioned earlier, from 12% of the overall revenue, VAS today contributes 15% of our overall revenue, and we see this number going to 17-18% over here. Because what we are noticing is a lot of customers, for example, if they have 2-3 of their offices within Indiqube, and they have 6-7 more offices across India, they are expecting us to manage those offices. So the scope of value-added services is going beyond Indiqube buildings. So that is a very healthy trend we are seeing now. So, and a plethora of B2B and B2C services that we have created. I think now we are seeing a good multiplier happening over here, which is ensuring that typically we will have a upward movement in the VAS. Now, from a margin point of view, most of this VAS is between 10 to 15%, and since these are early days of our value-added services, basically, so it will stabilize. But obviously, this will not be as accretive as our 20%, 18-20% EBITDA space business. So VAS will not have that kind of margin, but VAS will definitely have that scale, and VAS also gives us a very strong glue to hold our customers when you provide a lot of B2B, B2C, and all that. So yeah, and that is a good differentiator we believe we have been able to create for a lot of our clients.
Understood. This is very helpful. Thank you.
Thank you. We have our next question from the line of Vikrant Kashyap from Asian Market Securities. Please go ahead.
Hi, good afternoon, and congrats on a very strong set of numbers. To Rishi and Meghna, my question pertains to So the trends that you are seeing in the across the key micro markets, which includes Delhi, NCR, Mumbai, Hyderabad, and Bengaluru. So how has been the trend now, and how has been your sourcing plans in these key markets? And vis-a-vis, are you getting big buildings and large spaces being the high demand that we have seen in the recent past? Thank you.
So, good afternoon, Vikrant. Thank you. So, see, what is happening is, as you have noticed, that the global capability centers are continuing to grow, and most of these global capability centers prefer to go to tech parks and larger office spaces. So our uptake, our institutional uptake, which was about 16% of our portfolio, has now become 18%. So we are definitely seeing that a larger share of centers are coming up. Of course, this is more applicable to places where institutional supplies are available. For example, if you look at Hyderabad, now high-tech city in Hyderabad, you will not have a lot of grade B or those kind of spaces. So those places, most of our uptake is happening through other institutions. Similarly, on Outer Ring Road, we have signed up a good amount of space in Eco World, which is, I must say, the most premier tech park in Bangalore today. And we are continuing to double down on those kind of locations. City-wise, if I have to talk about, typically, because mostly more than cities, to be honest with you, we look at more micro markets typically, and we are now present in, say, about 17 cities, as you know. We don't see that we will continue to madly add more cities. Maybe a couple of more cities may keep getting added every year. So city addition, I think we are in a good shape now. Now the larger thing is that within those cities, what do we do with the micro markets? And like micro markets which have, say, 90% plus occupancy, like if you see Ginti in Chennai or OMR, Mahabalipuram Road, or you look at Outer Ring Road, or you pick up Golf Course Road, those are the kind of locations where basically our big focus will be there. We will not be very interested in going to locations like, say, Manesar or too much of North Bangalore or even Navi Mumbai for that matter in a way. Because the vacancy levels in those micro markets are more than 15 to going up to 25%. So wherever we see that there is a demand-supply equilibrium, the rental inflation of 4-5% is likely to sustain, we will be doubling down on those locations and also keeping in mind the metro proximity typically. And as you know, renovation is a big area for us typically. So we will continue to like about 25% of our portfolio is renovated buildings. So we will continue to pick up, like as you are seeing now, the transformation happening in Nariman Point area. So very similarly, a lot of cities are going through that. So renovation followed by our tech park pickup and doubling down on key micro markets, I think those will be the questions. And of course, our preference has always been to pick up full buildings, bigger buildings. So I think that will continue to be there wherever we see availability and we see the appetite to pick up the entire building.
Okay. Yes. Thank you, Rishi, for this clarification. One thing to continue on that, we have added a new cities in recent past, and that largely into tier 2 markets. So how has been trend in those markets, the new markets that you have entered? Could you throw some lights on that as well?
So, Vikrant, India, as you know, has 50 cities where population is 1 million plus. And today, unlike when somebody like me passed out 20 years back, today jobs are going where people are. So there is a democratization of jobs, and that is how you are seeing companies looking for distributed offices. And also the tier 2 story is clearly hinging on that fact. Now, certain tier 2 are better placed than others. For example, if you look at Coimbatore. Now, Coimbatore is the only South Indian city, non-capital city, which has a population of more than 3 million. And Coimbatore is like what Pune was 20-25 years back. So those cities, we are seeing very good traction happening over there. And there is a lot of healthy competition among different states for tier 2 cities. Also, the nature of business, what we are seeing going to tier 2 is slightly different. I can talk to you about like being the largest player in the down south, three states, basically, that what is happening over here is like a lot of healthcare back office work is going. to these cities. And the type of jobs are not like our engineering jobs. They are mostly graduates they are hiring, and 70% of the people they are employing are women. So different type of jobs are going to tier 2 cities, and then like that. So it's quite, I would say, democratic. I think, but while the tier 2 story is promising, but if you ask me, it's a 10-year story. The scale in tier 2 still is not there. And we have a lot of chicken and egg problem also. For example, you land up in a city and suddenly you realize there is no quality supply available there. And the landlords also don't have the maturity to handle a GCC or those kind of quality of clients also. So those issues are there. But it's a good trend, and our strategy has been that we put our flag in those locations and see how each of these cities behave and grow, and depending upon the response. Plus, our pickup of tier 2 cities is a combination of proactive reactive measures. For example, a client comes and says that I want to be in a particular city, an existing client, we will go and reactively basically pick up a supply and create that for them. But certain places like Coimbatore, when we went, we were quite hopeful based on our market research that looks like a promising city. So we picked up proactive supply. So it's a combination of proactive and reactive thing happening for these tier 2 cities.
Yeah. Okay. One another question on your investment to your solars, green energy. We have seen a quite uptake in last 2-3 years, and largely has been concentrated in and around Bangalore. So going forward, are you willing to put more of the investments in solar, make it one of the green, and so on those savings on the energy? If yes, then how are you placed? How much investment will go, and where are you more concentrated now after Bangalore?
Yeah. So, as I said earlier, we are looking at 3 states. Maharashtra, Karnataka, of course, is the largest for us, followed by Maharashtra and Tamil Nadu. And we have a 4 megawatt now plant operational in Maharashtra. 2.7 megawatt is getting operational in Tamil Nadu by next quarter. And Bangalore, we are continuing to grow our 20 megawatt facilities that we have. So I think predominantly focus will be on these 3 cities, and we will add about 30-35 megawatt of power in the year. And we see about 125 to 150 crores of capital expenditure going into the solar power to meet this 30-40 megawatt requirement.
Okay. One last question, if I can, is about one industry report that came out in the last 2 days, which talks about AI and the impact on flex co-working market, which talks about a very good things about co-working industry. So I just wanted to understand your thoughts with respect to the trend that they have highlighted, or maybe that trend that you are observing in the recent past. That's all from me. Thank you, and wish you best of luck.
Thank you. So basically, see, the trend is very positive, and as you know, my earlier venture has been into recruitment space. So what is happening is a few things which I can tell you. So this year, for example, campus hiring has been very, very robust. The big 5 pretty much have picked up almost 20,000 people on an average from campus. So that's a very healthy trend over there. Number 2, one of the large guys, the big 5 IT major, which typically pay 4 lakh on campus, they are hiring 8,000 people from campus at 21 lakh rupee salaries. So what it means is we are going back to the late 90s and early 2000s when campus hiring used to be confined to the top campuses. So there is so basically, if you look in the pyramid, while we are talking about very low-end jobs to be getting impacted, but the quality jobs are getting added in very, very substantial numbers. Roles like product management, roles like domain knowledge, those are in massive preference over here. And since companies are now looking at better quality of talent where the average salary is substantially higher, we are seeing the concept of premiumization coming in office spaces, where people are looking for plug and play, managed offices and all. They want a lot more flexibility also. They want to be closer to talent. So concept of distributed offices is coming in and all that. So I think overall, those are very, very healthy trends, and that's what the report that you mentioned a couple of days back also talks about. over there. So net, we are bullish, and number, as I mentioned to you, 82 million square feet absorption last year and 20 million absorption in the Jan-March period this year is clearly basically getting reinforced by this report as well over here.
Yeah. Thank you, and wish you best of luck.
Thank you.
Thank you. We have the next question from the line of Dhairya Trivedi from DJT Investments. Please go ahead.
Hi, sir. Thanks for taking my question. So over the course of the last year, we have seen several high-ticket deals in the GCC space, the latest one being that of Uber in Hyderabad. Now, if you look at any of these marquee deals, the MNCs, whether it is Uber or Nvidia, they're all taking up spaces which are upwards of 1 lakh square feet, and they are leasing it directly with the developer. So what do you think could be the reasons or advantages of these for these MNCs to lease directly as opposed to taking up space with a flex office provider?
Very good question. Thank you. So see, what is happening is that most of the large MNCs or large companies follow the strategy of hub and spoke model. So whenever they have a hub location, which typically is like, say, 2 lakh going up to, say, even 1 million square feet, that those offices, they tend to pick up on their own because they want very long leases. They do substantial investment into their IT infrastructure and all that, labs and data centers and all of that. So those assets are very, very strategic, and those they really want very long-term visibility, very high level of control and all of that. Now, then they look at spoke models. So basically where they want, suppose somebody has set up a big hub in Hyderabad. Now they know because of the talent availability, they would like to have a second R&D center in Bangalore or Pune or NCR and all that. So those are the places where they start coming to us. That is one trend we are clearly seeing, that the hub being done by them and spokes being done by us. Now, within that also, if you look at the hub locations that they have, there what they are doing, while they are signing up the real estate on their own, they are looking at a design and build service, where they are saying that basically, like, can you do the entire interiors and offer me a plug and play office spaces for a 5-year period? And multiple deals we have done, like typically with an automotive major Hyderabad, and then a mining major in Chennai, like that kind of deals are there. So it's going to be a combo. For example, if you think about a very large company which has 5 million portfolio in India, we are not expecting that the 5 million will move to us. We are expecting that 20-25% of that 5 million portfolio will be through flex. So what maybe 5 years back was not even 100,000 square feet, today is already 1.5 million. So you will see most of the companies will be blending, the large occupiers I am talking about. For them, it's flex is not going to be about 0 or 1. Flex is going to be about percentages. And we are seeing a very good trend as they are experiencing, getting the confidence that flex operators can deliver well. They are increasing the share of flex operators in their overall real estate portfolio in India.
And how would the commercials of leasing directly, compare with that of leasing, say, through a flex office provider for these MNCs?
So, depends upon the size of the real estate and the tenure of the real estate. For example, if they go to a company and they go to a large REIT, and if they are picking up maybe smaller offices, say 50,000 or 1 lakh of floor, vis-a-vis a flex operator going and picking up an entire block of 4-5 lakh square feet, then obviously the wholesale retail theory applies. And as a result, and if the tenures are longer, then the REITs are happy to basically give a 5-10% differential if the tenures are long and the uptake of real estate is very, very substantial. But to be very honest with you, there is not very significant difference in the cost at which a GCC will pick up real estate on its own vis-a-vis an operator doing it. But the moment you move to independent buildings, non-institutional supply, this wholesale retail theory plays out very differently. Like it could be as high as 20-25% difference. If you just pick up a floor vis-a-vis picking up the whole building, 20-25% rental difference could be there.
All right. And on our strategy of, leasing out entire office buildings, so I just wanted to understand a bit more about that. I mean, do we first kind of go and scout clients and then take up buildings based on the demand that we have? Or, do we first kind of, lease out the buildings and then look for a potential, companies to kind of lease that space?
Yeah. So 90% of our space uptake is speculative. where we believe that the markets are good, strong, based on our research. For example, suppose if I have a particular micro market and I already have 500,000 square feet in that micro market, I will not be shying away from picking up say 2 lakh square feet space, because I know that my 500,000 customers will grow and they will require space. So all those spaces are proactive. So our bulk of our strategy of picking up spaces has been proactive. However, it does happen that somebody comes in with RFP and the customer wants a particular location and we do back-to-back and all that. But back-to-back business is very limited. Also, if you see the single tenant, single building or single location is just 10% of our portfolio. That's not very substantial, because we believe single tenant, single location is a big risk. Because the day the client is gone, then we are back to square one. So we always prefer multi-tenancy buildings. If somebody is going, somebody is expanding, so that building doesn't see a zero occupancy at any stage. A big preference is there, and we believe this is very important from a risk mitigation point of view.
Right. Understood. And just one last question, on the revenue per occupied seat per month. So can you give some sense on, what that number would be in FY26 versus last year, and how it's likely to shape up for, FY27?
So typically about 192 rupees kind of average revenue realization is what we have for the last year, and most of our contracts come with a 5 to 6% rental inflation built in. So that is one fact that will happen. Plus, what is happening, as I mentioned, that we are now picking up a lot of institutional supply because of GCCs and all coming in, and these real estate tends to be more expensive and premium. So if we are picking up space earlier at an average price of say 70-80 rupees, now we may be doing a lot of properties at 20-30 rupees. So these are the two factors which will play out. One is the inflation, which is 5 to 6% into our contracts, and second is more in terms of the premium spaces and all we pick up. Plus, a lot of our supplies are into, as I mentioned, into key micro markets. So we also see, because of demand-supply mismatch, we have some pricing elasticity. Where if a particular tenant goes out or there is churn, we are able to lease out the space at a higher rate. So that also is happening. So a combination of all these three, so you can say that maybe 5 to 10% per inflation you see was in this 192 rupees over a year on an overall basis may happen.
Right. Understood. Thank you. Thank you very much, and all the best for the next financial year. Thank you.
Thank you.
Thank you. We have the next question on the line of Yog Rajani from Omega Portfolio Advisors. Please go ahead.
Hello. Hi. Thank you for taking my question. My first question is regarding the capex per square feet. As you can see, it has increased from 1550 rupees to 1650 rupees per square foot. Is there any reason for that?
Yeah. So war is underway, and that's a big culprit that we are currently seeing. So definitely what we are noticing is about 5 to 7% bump up has happened in a lot of materials that we are using. So what was 1550 is now trending towards 1650. But it is a small increase, and that too it's a capex kind of increase. So we pretty much at this point of time are absorbing it. We are not passing on to our clients. But luckily, while this number is increasing, we have not faced any major supply disruptions like PG supply when it got impacted. But tiles were in some short supply and all. But more or less, our supply chain and a large part of our procurement is luckily from vendors which are manufacturing everything in India. So the dollar also has not created a lot of havoc to that extent into our capex. So we see that this number will be about 1650. And also, as I mentioned, the whole thing about premiumization. So today, if you visit any of our offices vis-a-vis what we were doing 5 years back, you will see a substantially higher quality of interior. And those numbers are also budgeted in this 1550 going up to 1650. The 100 rupee is taking into account all that also over there.
Okay, fair enough. My next question is regarding the cash balance and is the utilization of cash. So I believe we have around 300 to 400 crores available to us in terms of cash and cash equivalents. And there was also some mention of variation of funds generated from IPO proceeds in the quarterly result update. If you could give us some more clarity on the utilization of cash and what that update would be about.
Yeah. So see, what we have is our IPO proceeds was totally like the primary that we raised was to a tune of 610 crores. Now, within that, the biggest chunk was 462 crores was towards capex. So what we have now done is we have basically look at that reallocation of that capex. So for example, 187 crores is what we have requested to be moved to other capital items. Like if you look at 50, like because as we mentioned, we are doing a lot of design and build. So design and build is where we don't have the real estate, but we do the design and build. As I mentioned to you for automotive major and all, the 55 crores towards interior capex has been allocated for that. And then I mentioned about solar capex, so 16 crores towards solar capex we have looked at, and 52 crores is towards payment of security deposit for the real estate that we are taking from landlords. Earlier this item was not there, and since we are picking up like supplies which are like where we are going at a land space, signing up LOIs with the landlords, and these are refundable deposits. So we need some money on that side. So again, a long-term item. And then we have kept 64 crores towards investment into any real estate or any adjacent ventures that Indiqube may see interesting coming up. So that is how 187 crores has been picked up. The general corporate purpose, which was 50.4 crores, has been kept the same, and the repayment of debt has not been changed. So it's more a reallocation of the capital expenditure across certain other heads, which we have seen since the time we filed our DRHP. They have become important, and we found it prudent that some money is allocated to them or priority.
Okay, fair enough. And also because there is significant amount of cash, while I believe, like, we have more cash available than, say, some other peers. Why aren't we being more aggressive with our growth strategy in terms of either larger sizes or more properties in our portfolio? Because if other people are growing fast, the question also arises, why can't we grow at the same rate given the management capabilities we have?
So I think, see, what we have, if you see, of course, more is always better that way, but if we have grown our revenue at 37%, typically, and purely if you look at the quality of growth, so we have been, because we believe that this business is not a winner-takes-it-all business. This business is like, to some extent, like our IT services business. You will have the big five in this space, and all of us have different strategies of growth. Our belief has always been sustainable growth, because we believe that growth at any cost comes at a huge cost. So we are quite focused on those parameters, and we are fundamentally looking at, because see, in this business, it's like if you look at the hotel business, right? A hotel which you pick up in a location like Navi Mumbai, 100 other 5-star hotels will come in Navi Mumbai. Right? So there is going to be massive value erosion. Now you may say that, okay, let me put growth on steroids and do those kind of locations. But since we are very focused on key micro markets, and key micro markets by nature tend to have limited supply. For example, if you want to grow in a dairy, right, you can't do magic over there. You have to grow in a prudent way. But an dairy property is so defensible that if you maintain it well for 20 years, 30 years, it will give you money. So I think, so we are very clear that the properties that we are picking up, the defensibility of the asset in terms of proximity to metro, availability of real estate in that micro market, and so many other factors is where we are focused on. But having said that, like as Meghna had mentioned that if you look at 9.6 million we have as AUM and 6.3 is rent yielding. So we have almost more than 50% of our occupied space available to us for leasing. So that is a good amount of headroom. And we have, if you look at our data earlier also, whatever is our occupied area, we try to have more than 50% of that available to us at any point of time as AUM. But at the same time, we have geopolitical situations. You have this whole big elephant in the room, AI, all that happening. So we do not want to basically go and take a position where we may repent that okay, we overshoot. And the other thing is, if you look at the landlord community, right? In Bangalore, 70% of my landlords are from one community, right? So this is like our banking relationship. The credibility with these people. So we are very wary of even leaving a single building where we have signed up and we have defaulted or left a building and left bad taste. I don't have any litigation at all with any of my landlords. So when you grow with that quality in mind, typically you always have that temptation to do that. But we definitely take your point. It is always on our agenda, and that is where you see our value-added services and all these things are growing. Our city presence is expanding over there. But definitely, like we are trying to see as much we can push and grow faster. Yeah.
No, fair enough. And just on the point of suggestions, like as Meghna mentioned, we can look at this business on a say quarter-to-quarter basis, just like a flowchart where we can understand how much area would be added every quarter would be very helpful for us to understand what we should expect, what you said, before we see the results rather than after.
Yeah. So basically, see, what happens is that in our business, and what Meghna said, I'm just substantiating that when any supply is picked up, it is front-loaded. Like, for example, if you pick up anything on 1st April, pretty much your rental starts there. And then we have a cycle where on an average about 9 to 12 months, we reach 90% plus occupancy. So whenever any large supply addition will happen, you will see variation happening in that particular quarter. So this is the challenge that will always be there. So that the right way is you look at a year-on-year 12-month number, because by that time the property would have stabilized. Plus the steady state occupancy is a better metric because it cuts out the noise. This 12-month variation goes out of all of that. So 12-month, hence those indicators are far more relevant to our industry. So you will always see this. As much we want to smoothen it out, but if you have a 3 lakh, like that's what exactly happened in Q4. We have a couple of large properties getting delivered, and that's where you are seeing all this blip happening over there. So those will continue to be there. But yes, but again, we pick up supplies well in advance. We don't go with a bag of money and pick up supplies. So 2 years, 3 years, we sign up well in advance. All those things we do to ensure that our supplies are smoothened out. But this bit of a cockpit turbulence, it is bound to be there in our journey. So yeah.
No, I completely agree. I'm not suggesting that we smoothen it out also at the cost of doing proper business, but some explanation in advance where we understand how much property will be added on a quarter-to-quarter basis would help us understand before the, how the year would proceed rather than waiting and understanding it after that.
Yeah, but I think that kind of a guidance we could look at, like basically that's a good suggestion that whatever we are expecting to be, say, becoming a rent-paying area in the next quarter like that, those could be basically disclosed in advance. Because those numbers are there with us. Some supplies may still get added. But yeah, by and large, we have visibility into what are we likely to have rent-paying area in the next quarter. So I think, yeah, that we'll consider and try to implement, yeah.
Since you said you have the numbers, could you share them with us? What would be the increase in the rent-paying area over the next 2-3 quarters?
So yeah, let us mull over it because that's the metric we have not shared till now. But again,
yes.
if you were to be honest with you, as Meghna told you, that if you look at 1 to 1.5 lakh square feet per month is what we will be adding in terms of rent-paying area. And about between 1 to 1.25 lakh is what will be a rent-yielding area, typically 80%. So that's what she said, told you is 80%. So if you look at, say, we are adding 1.25 lakh, 80% of that is 1 lakh. So that's what you are seeing, that between about 1 lakh going up to like 1.25 per month will be additions in the RYA. RPA addition maybe between 1.2 to 1.5. Typically. So that is the clear metric. It may slightly, some quarters you may see a blip. That is where she also mentioned that if you have to look at occupancy, look at the average occupancy for the 4 quarters, which was 84%, whereas Q4 was 81%. So those numbers then get, those errors are reduced actually if you take averages over larger database. Yeah.
Fair enough. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. As there are no further questions, I will now hand over the conference back to the management for closing comments.
Thank you all for your patience, and really appreciate you asking all the questions. Hope you found the whole thing useful. And we would like to thank our partners for Ambit for arranging this. Thank you so much, and I look forward to your continued support. Yeah, thank you.
Yeah, thank you all, and thank you Ambit team. Arun, thank you very much.
Thank you. On behalf of Ambit Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.